Hello, welcome to this conversation on the state of the markets and the economy. I am V K Vijayakumar, Chief Investment Strategist of Geojit Financial Services. With me is my colleague Sony Mathews, our Senior Market Strategist. Welcome, Sony.
Thank you.
Sony, as we speak in early December, the markets are at record highs. The Sensex is above 40,000 and the Nifty is about 12,000. A market expert recently described this rally as an unhappy rally, because he feels that vast majority of investors are not happy in spite of the fact that the markets are at record highs. If you look at the Sensex and Nifty, it is an impressive rally. But then if you look at the portfolio of retail investors, the portfolios are not performing. So what are your views on this so-called unhappy rally?
So, as you said, this rally has been marked by the complete lack of celebrations in the Lal Street. So, the markets are at all-time highs. It is seemingly ignoring the economic slowdown that the Indian economy is facing, the slowing revenue generation of the emerging corporate segment. This market is being driven by expectations of government reforms happening to boost the consumption cycle, of various, the economy recovering in the next couple of quarters. So that has been driving the market sentiments. It has also been supported by FII inflows, because we saw in November around 25,000 crores of FII money coming in. But and that has been a global sentiment. The central banks have taken a dovish stance. So, but then this money has been chasing the quality blue chips. So it has not been spread out. It has been concentrated into a few blue chip companies. They've been chasing stability. So the rally, or the rally is only in the indices. The rally has been driven by a few companies. As you were mentioning earlier, it has been driven by just 15 companies out of the top 50 Nifty.
Very narrow.
Very narrow this thing. So you have the broad segment that is not participating in the stock market rally, and you have a few blue chip companies that have been participating.
Right.
So the valuation divergence that we are seeing between large caps and mid caps is almost close to 10-year highs. Even within the large cap segment also we are seeing this divergence. So existing investors who are holding on to these stocks have not seen a broad rally in their holdings. It has been more of a concentrated holding. So this valuation, it is disturbing to a lot of people. I would like your opinions on, whether this polarized valuation will continue in the future, or will we see it narrowing down?
Well, as you said, the valuation polarization is very sharp. It may even appear irrational. The markets can be irrational at times. As the famous economist John Maynard Keynes once said, markets can remain irrational longer than you can remain solvent. So an element of irrationality will be there. We saw this irrational valuations in mid and small caps in 2017. And now we are paying the price for those excessive valuations. So yes, this is a problem, and these highly polarized valuations are not likely to sustain. Also, we must appreciate the fact that these highly polarized valuations are reflective of the underlying economy. In a normal bull rally, a so-called happy rally, we are having an unhappy rally now. In a normal happy rally, the rally will be broad-based. Look at the rally from 2003 to 2008. Large caps, mid caps, small caps, every segment will be participating in that, because that rally will be supported by economic growth, corporate earnings also. So the fundamentals will be driving, unlike the quantitative easing led money that is triggering this rally worldwide now. So the basic reason for this valuation polarization is the underlying poor performance of the economy. The economy has been performing very sluggishly. In fact, all the projections have gone wrong. I don't remember in recent times the RBI revising their GDP growth rate projections by 2 percentage points. They started with 7%, then reduced it to 6.9, 6.1 last year, and yesterday 5%. So this kind of a steep deceleration in the economy was not anticipated. Also, corporate earnings are at a record low now. Corporate earnings as a percentage of GDP is less than 3%. So unless we have sustained growth and sustained earnings growth, the rally is not likely to, become broad-based. But of course, let us hope things will change in 2020, maybe in the next 2 quarters or so.
Right. So Q2 GDP also came in at 4.5%.
Yes,
Now, the government was targeting a $5 trillion economy by 2025. Currently, we are in the range of $2.7 trillion. So that means almost doubling it in the next 5 years. So, as an economy, I think we would need close to around 9% growth rate, to achieve that kind of a target. So, it seems a little bit impossible. But then, will we see the old rates, the 7%, the 8% growth, GDP growth rates anytime soon? Do you foresee any recovery that is happening in the GDP growth rates?
Well, first let me respond to your concerns regarding this $5 trillion economy. There is no doubt that we will reach the $5 trillion mark and even go beyond $5 trillion to 7 trillion, 8 trillion and 10 trillion. But when we will reach that is the $1 million question. Well, the government's target is to touch a $5 trillion mark by 2025. Personally, I feel it will be difficult because you need a 12% nominal GDP growth.
Right. So that around 9% actually.
If it is 9%, then 3% inflation. 9% real growth is almost impossible. Even 7% now looks very daunting. But if you have a 7% GDP growth plus 4% inflation, that is 11% nominal GDP growth. At 12% nominal GDP growth, your GDP will double in 6 years. Right now, it is a very tall task. Maybe it may be delayed by 1 year. We need not be too much concerned about the timeline. It is quite possible that the economy will reach the 7 to 8 trillion mark by 2030. Right? But right now, our immediate concern is how the global economy also performs next year. According to the many economic models being used in India, 1 to 1.25% of our GDP growth is dependent upon the global economic performance. If the global economy does well and the international trade also performs well, then that will add 1.25% to your GDP growth. In all the years in which we grew at 8%, that favorable global environment
was that has not happened this year.
No, it has
support
not
has
happened.
Not been there.
The last 3 to 4 years it has not happened. Right? And next year also there are divided opinions regarding that. There is 20%, there is a consensus among economists that there is a 20% probability of a global recession next year, particularly if the China-US trade talks deteriorate and a consensus eludes. But then if there is an agreement between US and China, which many political commentators feel is inevitable because President Trump's second tenure in office also depends on the performance of the US economy. So that is a very good probability. So if the global economy performance turns favorable in 2020, we will also benefit out of that. Improvement in global trade will benefit us, and also the monetary stimulus provided by the RBI. Even though yesterday the RBI surprisingly
maintained status quo.
Yes, status quo was rather surprising. Some people described it as a shock because the consensus was 25 basis point.
But the market was not bothered.
Market was not bothered because this is the kind of resilience which the market have now. As you said, the quantitative easing is unleashing a lot of liquidity in the global economy, and consequently there is a risk on in the global markets. All the global markets are doing very well. $17 trillion invested in bonds are yielding negative rates of returns. So money is chasing returns elsewhere. So that's why we have this risk on, and money is coming to all markets, including emerging markets. So this monetary stimulus that has been implemented and the fiscal stimulus which the government is trying to give All this can produce some results after let us say a gap of a couple of quarters.
Right.
So it is quite possible that in early 2021, that is from April June quarter of financial year 2021, a clear turnaround in the economy is very much on the cards.
Right.
So we should be thinking of the right kind of strategy. As a market strategist, you should be thinking about the right kind of strategy that we should advise our investors on.
Yeah. So, I mean, too early to talk about it, but then hopefully the next budget will be the full budget of Modi 2.0. So, I think people are also expecting a lot of reforms to happen over there. So, with specific inputs with regards to the stock market performance, the recently concluded earnings season was okay in terms of earnings performance
because of the corporate tax
cut. So, there's no fundamental change that has happened. But then we need to see some broadening of the rally so that, you know, people start participating in the returns, people start enjoying the returns of quality mid caps as well as the large caps, which you can continue to hold. So, our strategy has always been to, currently, to invest into the quality mid caps and the quality large caps, the fundamentally strong large caps. So one of the best ways to do that is through the mutual fund route also. And we've been telling all the investors to start off their SIP investments, systematic investment plans through the mutual fund route. And the multi-cap segment would be one of the best ways to enter into the
ideal at this point.
Ideal at this point, because you get exposure into the large, mid and small caps also a little bit. And our 5-star rated mutual funds in the multi-cap category, we have Kotak Select Multi-Cap, which is a 5-star rated fund, and SBI Magnum Multi-Cap is also a 5-star rated fund by Geojit. So
and consistent
performers, and we've been advising people to start off their investments, SIP systematic investment plans, into the multi-cap route first. And of course, you can also have some mid-cap exposure. In the mid-cap category, we've been advising Axis Mid-Cap Fund, which is a 5-star rated fund, and an L&T Mid-Cap Fund, again, which has been giving good, stable performances in the mid-cap category. So these would be two categories that investors can look at. Existing investors, if they want to boost their portfolio a little bit, you can look into the multi-cap, mid-cap segment, and also for new investors looking to enter into the market. So that would be the ideal strategy. I would like your views also on that.
Yes, I will summarize based on what you have said right now. Let me summarize our thinking on this. Some top stocks in Nifty, 10 to 15 stocks, are very richly valued. Therefore, it does not make sense to buy aggressively into those stocks.
Yes.
But people who are investing in SIPs in the large cap funds should continue to do that, because it is impossible to time the markets. Then new investors can certainly think of starting SIPs in the multi-cap segment, because multi-cap segment will give a lot of flexibility to the fund managers, and therefore if some stocks are overpriced, overvalued, they can move out. Then mid-caps, and what about large and mid-caps? That
large and mid-cap category is also a good category. So if you want a mix of large and mid-caps.
So large caps remain invested, continue with the SIPs. Investors can think of even bulk investments in mid-cap segment, because the valuation comfort is there. Large cap and mid-cap, and also mid and small cap funds, SIPs are the way to go. This market will test the patience of investors, but then the market has a habit of rewarding patient investors. Thank you very much.